macro currency signals.
We are entering a phase of the global system that most investors are not prepared for. Not because markets are volatile, volatility is normal, but because the assumptions that supported the last 80 years of growth are breaking at the same time. This is not a crash story, this is a system transition story. Let me walk you through 6 key points that explain why this moment matters. The global financial system we've lived under for nearly a century is built on one core assumption: the future will be larger than the present. More people, more jobs, more income, more consumption. That assumption is so deeply embedded in markets that most investors never even question it. Debt only works if tomorrow can reliably pay for today, and for decades, that bet paid off. Governments borrowed, corporations borrowed, households borrowed, and as long as the workforce kept growing and productivity rose alongside it, the system held together. This is what economists call a debt-based growth model. Money is pulled forward from the future to fuel expansion in the present. That expansion then generates enough income to service the debt and justify even more borrowing. It's why asset prices are valued not on what they produce today, but on what we believe they will produce years from now. Stocks, bonds, real estate, everything is priced on expectations of future cash flow. As long as those expectations remain credible, the system looks stable, even elegant. But here's the problem. The future we are now pricing into markets is fundamentally different from the future this system was designed for. We are simultaneously betting on explosive technological productivity and a shrinking role for human labor. Artificial intelligence, automation, and robotics are being celebrated for their efficiency, but efficiency comes at a cost. These systems don't earn wages, they don't pay taxes, they don't take out mortgages or borrow to start businesses. They replace income-generating humans with capital-owned machines. That creates a contradiction the markets are only beginning to confront. On one hand, valuations assume growth, expansion, and rising earnings far into the future. On the other hand, the very technologies driving those valuations threaten the income base required to sustain them. A debt system requires borrowers, it requires workers, it requires rising participation. A highly automated economy reduces all three. Both narratives cannot be true at the same time. This is the paradox at the heart of the next phase of the global order. Productivity may rise, but if the number of people earning income declines or stagnates, the system loses its ability to recycle debt safely. Fewer workers mean fewer taxpayers. Fewer borrowers mean weaker demand. And weaker demand undermines the justification for today's asset prices, which are built on optimistic assumptions about future growth. Investors are starting to sense this, even if they can't articulate it clearly yet. That unease shows up as volatility, it shows up as sudden repricing of risk, it shows up in sharp sell-offs that don't seem to match the headlines of the day. Markets are forward-looking, and what they're struggling with is not today's data, but tomorrow's uncertainty. If growth becomes less human-driven and more machine-driven, who ultimately captures the income? And how is that income distributed back into the system? This matters because debt doesn't disappear quietly. When confidence in future cash flows weakens, leverage becomes dangerous. Borrowing that once looked prudent suddenly looks reckless. Assets that depended on cheap money and stable growth lose their foundation. The system doesn't fail all at once, but it becomes fragile. Small shocks cause outsized reactions. Liquidity dries up in places investors assumed would always function smoothly. We are now at the point where this contradiction is no longer academic. It's being reflected in how investors think about risk, duration, and exposure. The future no longer feels like a guaranteed engine of growth. It feels uncertain, uneven, and increasingly detached from the assumptions baked into decades of financial models. And when the future becomes unclear, debt loses its anchor. That's when the system starts searching for a new equilibrium, and that search is rarely calm. If this breakdown is resonating, make sure you're subscribed and notifications are on. Being early matters in moments like this. Drop a comment and let me know where you're watching from and what time it is on your side of the world. This is a global conversation, and I'll see you in the next one. For most investors, leverage feels invisible when it's working. It hides inside balance sheets, derivatives, funding markets, and low interest rates. For years, borrowing money felt safe, almost rational. If capital was cheap and returns were higher, why wouldn't everyone borrow? Companies borrowed to buy back their own shares. Investors borrowed to amplify returns. Governments borrowed because markets assumed they always could. Leverage didn't feel risky because the system itself felt predictable. That predictability was the real foundation of the modern financial system. It wasn't just low rates that mattered, but the belief that those rates would stay low, stable, and manageable. Central banks became shock absorbers. Whenever something broke, liquidity arrived. Whenever markets panicked, policy stepped in. Over time, investors stopped asking whether leverage was safe and started assuming it was permanent. But leverage only works in a world where the rules don't change, and today the rules are changing. One of the least understood but most important stabilizers of this system was Japan. For decades, Japan provided the cheapest money on earth. By keeping interest rates near zero and sometimes below zero, it became the global source of funding. Capital borrowed in Japan didn't stay in Japan. It flowed into US stocks, European bonds, emerging markets, real estate, and eventually into speculative assets. This structure allowed leverage to spread quietly across the entire world. Japan made this possible by prioritizing its bond market over its currency. Through aggressive bond buying, it kept yields artificially low, even as debt levels ballooned. The cost of this policy was a steadily weakening yen, but as long as the system remained stable, that trade-off was accepted. Markets learned to depend on Japan's consistency, even if they rarely acknowledged it. That consistency is now breaking. Japanese bond yields are rising at speeds not seen in decades. When yields rise, debt becomes more expensive to service, and Japan carries an enormous debt burden, both domestically and through its exposure to foreign bonds. This creates an impossible dilemma. If Japan defends its currency by allowing rates to rise, debt costs surge and leverage begins to unwind. If it suppresses yields again, the currency weakens further, pushing inflation and capital flight. Either path creates instability, not just for Japan, but for the global system built on cheap money. This is why stress in Japanese bond markets doesn't stay local. When yields spike in Japan, global funding costs rise, US treasuries react, European bonds react, risk assets reprice. Leverage that once looked sustainable suddenly looks dangerous. Investors who borrowed short-term to hold long-term assets are forced to reduce exposure. And when that happens, selling becomes mechanical, not emotional. This is how deleveraging begins. Deleveraging doesn't ask whether assets are good or bad. It sells what can be sold. The most liquid markets move first. The most leveraged positions unwind fastest. Correlations spike because everything was connected by borrowed money. What looks like panic is often just math catching up to optimism. And this is why volatility feels different now. It's not driven by headlines or data releases. It's driven by structural shifts in how money is priced. When the cost of capital rises in a system built on cheap capital, pressure builds everywhere at once. Investors are now being forced to relearn something the system made them forget. Leverage is not neutral. It amplifies gains in stable times and accelerates losses when stability fades. And when the foundation of predictability cracks, leverage becomes the enemy, not the advantage. We are entering a phase where borrowing is no longer automatically rewarded, where rolling debt forward is no longer guaranteed, and where the global system must adjust to a higher cost of uncertainty. This isn't the end of the system, but it is the end of the era where leverage could expand without consequence. For decades, the global financial system worked not because it was perfect, but because it was trusted. Investors trusted that rules would be followed. Nations trusted that agreements would hold. Markets trusted that money would mean the same thing tomorrow as it did today. This shared belief created something more valuable than growth itself: predictability. And predictability is what allowed leverage, trade, and global integration to expand without constant fear of collapse. That trust was formalized after World War II through a rules-based global order. The United States sat at the center as the issuer of the world's reserve currency and the ultimate security guarantor. Trade routes were protected, capital flowed freely, disputes were managed within predictable frameworks. Whether countries liked the system or not, they understood it, and because they understood it, they built their economies around it. But trust erodes slowly and then suddenly. Over time, the assumptions that held this system together began to fracture. Trade was no longer just trade. It became a weapon. Sanctions replaced diplomacy. Supply chains were exposed as vulnerabilities rather than efficiencies. And nations began to realize that relying too heavily on a single system meant surrendering a degree of sovereignty they could no longer afford. This is where the New World Order begins. Not with an announcement, but with quiet decisions. Countries start diversifying reserves. They question what truly backs their money. They reconsider who they depend on in a crisis. And once that process starts, it doesn't reverse easily. Money, at its core, is a promise. A promise that value will be recognized, honored, and transferable in the future. When trust in that promise weakens, markets don't collapse immediately, but they become unstable. Investors demand compensation for uncertainty. Risk premiums rise. Capital becomes selective. And leverage, which depends on smooth global coordination, starts to break down. This uncertainty forces a difficult question. What is money in a fractured world? Is it a government bond, a currency, a commodity, a digital ledger? There is no single answer anymore. And when markets don't agree on what constitutes safety, pricing becomes chaotic. Assets that should trade in lockstep begin to diverge. Paper claims disconnect from physical reality. Regional markets reflect local trust rather than global consensus. This breakdown shows up most clearly where the system assumed uniformity. When physical assets trade at different prices depending on geography, it's a signal that confidence in global settlement is fading. It means nations no longer assume that contracts will always be honored the same way, everywhere, under all conditions, and that shift has enormous implications for investors. Global portfolios were built on the assumption that capital could move freely, that currencies were interchangeable, and that risk could be diversified across borders. But diversification only works when correlations behave as expected. When trust erodes, correlations spike. Assets move together, not because they are the same, but because investors are rushing toward perceived safety. Geopolitical uncertainty doesn't need war to disrupt markets. It only needs doubt. Doubt about alliances, doubt about enforcement, doubt about settlement. And once doubt takes hold, investors demand higher returns for holding risk, or they exit altogether. This is why markets feel more fragile today, not because the world is ending, but because the glue that held it together is weakening. The old system relied on shared rules. The new system is being shaped by competing interests. In times like this, markets don't trend smoothly. They lurch, they overshoot, they correct violently. Volatility becomes a feature, not a bug, and investors who mistake this for noise miss the deeper signal. The global order is being renegotiated in real time. This isn't the collapse of globalization, it's its transformation. And transformations are rarely comfortable. When systems come under stress, the damage doesn't appear where people expect it. It doesn't start with headlines or official announcements. It shows up first in markets, because markets are the only place where millions of people are forced to put real money behind their beliefs about the future. Prices move before narratives catch up, and when uncertainty rises, markets don't ask for permission to react. This is why volatility is not the disease. It is the symptom. When the future becomes harder to price, markets begin searching for clarity through motion. Prices rise and fall not because investors suddenly became emotional, but because assumptions are being tested. What once felt stable now feels fragile. What once felt liquid suddenly feels crowded. And assets that were treated as safe reveal how dependent they were on leverage and confidence. The most important thing to understand is that stress does not hit all assets equally or simultaneously. It moves through the system along the paths of least resistance. The easiest assets to sell are always the first to move. Liquidity becomes a liability. When investors need to reduce exposure, they don't sell what they believe in the least. They sell what they can sell the fastest. This is why highly liquid, globally traded markets often absorb shocks before everything else. These markets act like pressure valves. They respond instantly to changes in sentiment, funding conditions, and risk appetite. Because they trade around the clock and across borders, they reflect fear and relief in real time. As leverage unwinds, correlations rise. Assets that are normally unconnected begin moving together. This creates the illusion that nothing is working, that diversification has failed. In reality, diversification hasn't failed. Leverage has. When borrowed money exits the system, it exits everywhere at once. The same forces that inflated prices on the way up compress them on the way down. This is also why market moves during transitions feel violent. They are not driven by fundamentals alone, but by forced adjustments. Margin calls don't care about long-term value. Risk limits don't care about conviction. When thresholds are breached, selling becomes automatic. And once selling feeds on itself, prices overshoot in both directions. These moments are deeply uncomfortable, but they are also revealing. Markets expose which assets were held for belief and which were held for yield. They expose which positions depended on stability and which were resilient to chaos. And they reveal how much of the financial system was built on confidence rather than certainty. It's important to understand that this does not mean everything is broken. It means the system is recalibrating. When long-term assumptions change, prices must adjust. The mistake investors make is assuming that stability is the natural state of markets. It isn't. Stability is engineered. And when the engineering changes, volatility is the result. This is why transitions like this don't resolve quickly. They unfold in phases. Periods of calm are followed by sudden stress. Rallies occur inside broader uncertainty. Fear and optimism alternate as markets try to find a new equilibrium. The goal is not to predict every move, but to understand the environment in which those moves are happening. The investors who struggle the most during these periods are not the ones who are wrong. They are the ones who are overexposed to a single outcome. Systems in transition punish certainty. They reward flexibility, patience, and risk awareness. Volatility is not a message to panic. It's a signal to reassess, to ask what assumptions are embedded in your portfolio, to understand where liquidity, leverage, and time horizon intersect, and to recognize that protecting capital during uncertainty is just as important as growing it during stability. The next phase of the global order is not about predicting collapse or chasing returns. It's about navigating change. And change always begins with discomfort. Markets are not broken. They are speaking. The question is whether investors are listening. When uncertainty rises and systems begin to shift, the most important question investors ask is deceptively simple. Where did the money go? When markets fall together, stocks, bonds, commodities, and speculative assets, it feels like value has vanished. But money doesn't disappear. It moves. And understanding where it moves during periods of stress reveals more about the future than any headline ever could. In times of stability, capital chases growth. Investors are rewarded for taking risk, extending duration, and leveraging exposure. But when confidence breaks, priorities reverse. The goal shifts from maximizing return to minimizing regret. Capital stops asking how much it can make and starts asking how much it can lose. This psychological pivot happens quickly, and once it does, money seeks familiarity, safety, and reliability. That's when capital rotates toward assets that feel boring. Companies with stable cash flows, businesses that sell necessities rather than aspirations, assets that generate income regardless of market mood. These are not the assets that dominate bull markets, but they are the ones investors return to when the future becomes unclear. They don't promise explosive upside, they promise survival. This shift is not driven by fear alone, it's driven by time horizon. When investors are unsure how long uncertainty will last, they favor assets that can sustain themselves. Dividend-paying companies, strong balance sheets, and predictable revenue streams become more attractive because they reduce dependence on market timing. Income becomes a form of psychological stability. At the same time, leverage retreats. Loans are paid down. Positions are reduced. Cash buffers increase. This process is often misunderstood as pessimism, but it's actually discipline. In an environment where assumptions are being rewritten, flexibility is more valuable than conviction. Cash, once dismissed as unproductive, becomes optionality. It allows investors to respond rather than react. This is also when diversification reveals its true purpose. Diversification is not about owning many assets. It's about owning exposures that behave differently under stress. Investors who built portfolios around a single narrative, growth, inflation, technology, or liquidity, discover how fragile those narratives can be. Resilience comes from balance, not bravado. Another important shift during these periods is the separation between speculation and ownership. Assets held for short-term price appreciation behave very differently from assets held for long-term preservation. When volatility rises, speculative positions are the first to be liquidated. Ownership-based positions, especially those tied to real utility or tangible value, tend to remain more stable. This doesn't mean risk disappears. It means risk changes form. Instead of being hidden inside leverage and correlations, it becomes visible in opportunity cost and patience. Investors must decide not just what to own, but why they own it. Are they prepared to hold through uncertainty? Are they comfortable with drawdowns? Do they understand the risks they've accepted? Perhaps the most overlooked element of this phase is emotional control. Market stress exposes behavioral weaknesses faster than analytical ones. Panic selling, overtrading, and chasing rebounds are not strategies, they are reactions. Investors who survive long transitions are not necessarily smarter. They are calmer. They design portfolios that allow them to stay rational when others can't. This is not a call to retreat from markets. It's a call to engage with them differently. Periods of uncertainty often produce long-term opportunity, but only for those who preserve capital and perspective. The goal is not to predict the exact bottom or top. The goal is to remain solvent, flexible, and psychologically intact. The next phase of the global order will reward patience more than prediction, discipline more than daring, and understanding more than excitement. In times like these, survival is a strategy, and strategy is what turns uncertainty into advantage. Every major shift in the global system eventually forces the same question: what survives? Not what performs best in the short term, not what captures attention, but what endures when assumptions break and structures change. The next phase of the global order is not about predicting a single outcome. It's about positioning for a range of outcomes in a world where certainty is fading. History shows that transitions are never clean. They don't arrive with a single event or a clear turning point. They unfold unevenly, with periods of calm followed by sudden disruption. Old systems persist longer than expected, even as new ones quietly take shape. Investors who wait for confirmation often arrive too late. Those who recognize the shift early focus less on precision and more on resilience. In environments like this, long-term thinking becomes a competitive advantage. Time horizon matters more than timing. Investors who can withstand volatility without being forced to act gain flexibility. They are not pressured into selling at the worst moments or chasing narratives at the peak. Instead, they allow compounding to work through uncertainty rather than against it. Ownership, not exposure, becomes increasingly important. Systems under stress tend to favor assets that cannot be endlessly replicated, rehypothecated, or diluted. When trust weakens, control matters. Assets that are directly held, clearly defined, and transparent tend to behave differently from those layered with complexity. Simplicity becomes strength. This doesn't mean abandoning innovation or growth. It means understanding where growth comes from and how it is financed. Not all progress benefits investors equally. Some technologies increase productivity without increasing broad income. Others concentrate returns while dispersing risk. Long-term capital must distinguish between advancement that strengthens the system and advancement that quietly undermines its foundations. Another critical shift in this phase is the repricing of patience. In a world of constant information and instant reaction, the ability to wait is undervalued. But periods of transition reward those who resist the urge to over-optimize. The biggest mistakes are rarely made by those who move too slowly. They are made by those who move too often. Risk in this environment is not something to eliminate. It is something to choose deliberately. Investors must decide which risks they are willing to accept and which ones they are not being compensated for. Unpriced risk is the real danger. When markets assume stability that no longer exists, risk hides in plain sight. This is also the phase where humility matters. No one fully understands how the next system will function. Monetary frameworks evolve, political alliances shift, technology reshapes incentives. Pretending certainty in an uncertain world is a liability. The strongest positions are those that allow for adaptation rather than demand prediction. The next global order will not emerge overnight. It will be built through experimentation, conflict, negotiation, and adjustment. Some structures will fail, others will be reinforced. The process will feel chaotic, but it will also create opportunity for those who remain grounded. For investors, the goal is not to outsmart the system, but to survive its transformation. Capital preserved through uncertainty becomes capital that can be deployed when clarity returns. Perspective maintained during volatility becomes conviction when others hesitate. This moment is not the end of opportunity. It is the end of complacency. The next phase has begun, not with a collapse, but with a recalibration, and the investors who understand that difference will be the ones still standing when the new order finally takes shape.